Would you like to buy a home of your own but can't because you're short on your down payment and you feel stuck? In this video, I will explain 4 ways that you may still be able to buy a home even though you may be short some or all of your down payment. Hey, what's up everybody? Thanks for watching the channel. Hey, I'm an active realtor. I've been doing this a long time and I've seen about every situation out there, and I've seen lots of people that thought they were not able to buy a home simply because they didn't have the right information. So if that's you, subscribe to the channel and leave your questions in the comments below. Leave your problems, because many times we do have answers for these. No, it's not possible for every single person to buy a home today, but we can help get you there. And I work with people all the time. We've worked with people for up to like a couple of years to get them ready to buy a home. I can go through stories of people that didn't think they were going to be able to buy, and weeks or like a couple months later, we moved them into their first home. So my contact information is below. So reach out with your questions. I'd be glad to do what I can to help you out. And if you're in the Calgary area and you're looking to buy or sell a home, I'm a very active realtor, good at what I do. Reach out to me and we can talk. In Canada, a 5% down payment is necessary to qualify for mortgage financing to buy a home. While it is always easiest to have this available in cash, it's not always possible for everyone. So what are the options if you don't? Here are 4 strategies. 4th one is a little creative. The first option that many people find very easy is if they have an RRSP. Now, if you haven't owned a home in the last 5 years, you can withdraw money from your RRSP using the first-time homebuyers plan. And in most cases, if you're careful, there are no immediate tax implications to taking this money out of your RRSP, meaning the tax is not deducted when you take the money out. You do have 15 years to pay it back, or to declare 1/15 of the amount that you took out every year as income. And of course, that is a much smaller tax implication than taking it out all at once. Wow, this is a great option for many people. Make sure you check with your tax accountant and your banker just to make sure the right paperwork is filed so that you don't end up with a tax bill at the end of the day. The second great option that is very commonly used is a gifted down payment from immediate family. Now, this is really important, although quite often people will gift this money back at a later date. This needs to show up as a gift and not a loan. This needs to be accompanied by a gift letter, and your mortgage broker can help you with a proper format for that. A loan would mean that it would show up on your expense statement and affect your total debt service ratios. Of all these options, this does seem to be the most popular one. Now, the third option works well for people with a very strong income and a very low total debt service ratio. So what some people are able to do is take some or all of their down payment out of a line of credit, set up a line of credit, withdraw some of the money. It may have to be done like 90 days ahead of time, and then they're able to use that down payment or that cash as down payment for a home. Just a note, though, that the payments, usually 2% per month on the balance of the loan or of the line of credit, will need to be added as a debt payment in your total debt service ratio. So this is the least popular, but it does work for people that are making a very modest purchase but have very strong income. Now, here's the 4th and most creative option, and it's a bit of a combination of number 1 and number 2. This is where you have some of your down payment, but not the entire amount. So let's sketch it out for you. Let's say you're trying to buy a $200,000 property, 5% down payment is $10,000, and let's say you have $8,000, but you're still short $2,000. Let's further assume that you're making $50,000 a year or more and $100,000 a year or less, and thus would have a marginal tax rate of just over 20%. So here's how it works. You deposit the $8,000 into your RRSP before the RRSP deadline, and then the next spring when you file your taxes, you would get a tax return based on your marginal tax rate, in this case 20.5%, on $8,000, and you would get a return of about $1,640. Then, as long as the money's been in your RRSP at least 90 days, you can withdraw the $8,000 on the first-time homebuyer plan, RRSP $8,000 plus the $1,640 in a tax return. You have $9,640. So you have about 97% of your down payment. You just had a big boost to your down payment amount, and so you only had like $360 more to save. Boom, you have your down payment. Let's go buy a house. Now, you could work through all of this yourself, but if you're serious about buying a home, no matter where you live in Canada, I can connect you with a mortgage professional that can walk you through all of this for free. These experienced pros work with lots of different banks, giving you lots of options. So just email me with your contact information at the address here below, and I'll reach out to you and make the connection. Now, if you liked this video and found it helpful, please click on like. It just helps to get it out on the YouTube algorithm. And make sure you subscribe and click the notification icon to make sure you don't miss any future videos. See you on the next video.